Hi, and welcome to the Macro Show. We talk macro and try to make sense of markets. Whew, man. You probably tuned in just to see if I was going to wear the crown today. But yes, the walls of the kingdom have held in what is now the third day of the special edition of Macro Show, Kingdom Under Siege. And yes, sellers are back in a big way. Brent Johnson of Santiago Capital was generous enough to send us a chart. We'll take a look at the speculative positioning. As you saw by the title of the show, the dollar is crashing. What does it mean? What's going on? Oh no, don't tell me, Steve, you're still bullish. I just don't get it? I know many of you are going, yeah, you don't get it, and you're hitting the comments right now. How can I be dollar bullish when it's blatantly going down? I'm going to show you from a macro perspective how I can be macro bullish on the dollar, even though the tape's going down. I know, it's crazy because the dollar is telling us something. It's screaming out loud that there are major problems going on and it's not fixing anything. From a market perspective, we've seen stocks just defy logic. One of my clients called me this week and he's a big PE guy, price to earnings ratio. And he called me up and said, Steve, do you know what the PE of the S&P is? I'm like, yeah, it's pretty high, isn't it? He goes, why are people buying? I said, there's two reasons. One, they actually think the economy is going to rebound higher and justify higher stock prices, or it's a greater fool theory that hopefully someone who doesn't know the stocks are massively overvalued will gladly buy at this price from them. He laughed and said, yeah, sounds like the greater fool theory to me. And why does that have to do with the dollar? Well, it's simple. What have we seen in the market going on lately? Right? We've seen people short volatility, and that didn't work out. Now they're heavy short the bond market, and they can't get interest rates to go up any higher. And so what's last? Short the dollar, drive the dollar down because everyone's already crammed into stocks. So how do you make the market go up? How do you get stocks to go up when everyone's in them? You take big positions on short volatility, short bonds, and short dollar. And now we're in a position where the dollar has to fall. The dollar's got to be bearish going forward. And if it does rally, it is going to be a wrecking ball. We've got economic data. We've got lending growth data. There's nothing pretty there. Ton of stuff on the dollar. Let's just jump right into it. Because what does a falling dollar tell us? It should be good. President Trump has been wanting for 4 years. He's been wanting a falling dollar, right? And what is that for? To increase exports. But is that helping? Well, no. And if it did, we should also see it help employment. But here's export price index on a year-over-year basis versus the trade-weighted dollar. And normally when the dollar is falling, as you see it in red, the export price index is up, meaning there's demand for U.S. exports. But it's not doing anything. I mean, you can clearly see where the blue line is headed up and the dollar is headed down. But for some reason right now, the dollar is headed lower and export prices are decelerating and they're negative on a year-over-year basis. That doesn't make any sense. But there's something that we have to address because so many people think that stimulus is money printing. It's not. It's like Robin Hood. You take from the rich, you give to the poor, except borrow from the rich, give to those who need it. That's what it is. The federal government is a dollar redistribution machine. That's what you should see it as. It is not creating dollars when it borrows them because they're not borrowing them from the bank. They're borrowing them from people who already have them. And QE, as we previously established, is not money printing. Like even Fed Chair Powell at his the November press conference, and I wish I had a clip of the Q&A session. When he was asked, if the Fed was printing money, he says, no, all we are doing is changing the nature of a bank's reserve. And that was Fed speak for we're shortening the duration. We're taking a 30-year bond, for example, that has a long duration and shrinking it to an overnight asset, as we've heard Dr. Lacey Hunt say. They're not doing anything. It's not money printing. There's $0 printed. And yet QE is actually dollar bullish. And if you're dollar bullish, you're bond bullish. Because I mentioned in the show the other day, I was talking to Colorado Travis, right? And we had this discussion where it's like, once you realize that all a dollar is a zero duration treasury bond, you get why they tend to move together over time. It's the same thing. So if the Fed's doing QE to lower interest rates and raise bond prices, then isn't QE bullish for the dollar? Well, it is. Let's go take a look. Here's the monetary base. Now we know that quantitative easing can raise and lower the monetary base. That is exactly and only what it can do. And so I've got the trade weighted dollar against it, and you can see when the monetary base rises, it's in blue, that the dollar tends to follow it. But yet what's happening now is the dollar is being sold and dumped. Meanwhile, the monetary base is ticking higher. So what you're seeing here is just a snippet of how can I be dollar bullish and bond bullish, both of them many of you think is completely insane position, because I'm betting on the Fed. What? I know. Everyone says you can't fight the Fed. They do it backwards. They're doing it backwards. That's the whole point. The Fed can't raise stock prices. Everyone thinks they can, but the Fed can actually cause the dollar to go higher and bond prices to go higher. And yet many people believe that the Fed wants a weaker dollar. Guess what? The Fed has no control or direct control over the dollar. Neither does the U.S. Treasury. But by raising the monetary base and through quantitative easing, they can increase the value of the dollar. And you can see it again in this chart right here. So what's driving the dollar lower? Well, one of the reasons is people are dumping dollars. They don't want them right now. You can see institutional money funds. This is the cash in your brokerage accounts, IRAs, 401ks, large institutional money managers. And the dollars are going down. And so is the dollar. People don't want them. They want stocks and other things. And it's putting downward pressure on the dollar. But will it last? No, because eventually this money is going to come back to the institutional money funds when stock prices go down. I know you're thinking, well, that's never going to happen again. How about the relationship between 10-year Treasury yields and the dollar? As I pointed out in the past, they're like a couple that is dating. And they're together frequently, but from time to time they get apart and one has to come back to the other. But look at this. The dollar is going down and Treasury yields aren't going up that much. I mean, what you should see, right, is when the dollar's going down, we should see yields going up. So you see, here's dollar going up, yields going down, dollar going down, yields going up. What gives? See, it's telling us there's something wrong here. The fact that the dollar is falling and Treasury yields are marginally responding to it tells us there's a problem. Yields should be higher. Why do you think there's this massive bet against yields? It's because people are now looking at the dollar going, yields have to rise. It means the only thing that can happen. Where's my up arrow for yields? It's the only thing that can happen right now. The dollar is telling us, unless there's a bigger problem, unless there's actually a bigger problem and the dollar is having no effect on it. How about the consumer price index? Why is everyone bullish on? I know I just lost some of you because I pulled up the CPI chart. I get it. But why are people so nervous and bullish on higher consumer prices? Well, it would make sense. When the dollar goes down, consumer prices rise. We can see that in multiple occasions here. But look at this. The dollar's going down and the CPI went up a little bit and rolled over. It's telling us something is wrong in the system when everything is not responding to a fairly sizable move in the dollar. And yet the answer is, well, it's going to go lower and everything's going to change. Well, maybe it is, but maybe we just don't know what the problem is. It's the Fed. See, this is the money multiplier. We haven't looked in a while because they don't update it very often now anymore. It's the M2 money supply divided by the monetary base. It is one of the best approximations for deflation and inflation. So when the money multiplier is rising, says that it's possible inflation can come. When it's falling or flat, it's telling you there's deflation. When it's flat, when it's falling, it's telling you it's deflationary. And so the dollar is falling here, and the money multiplier is not even moving. It's telling us, hey, something is wrong here, because you can see when the money multiplier crashes, the dollar rallies. When the money multiplier crashes, the dollar rallies. Who crashes the money multiplier? The Fed. And look, the dollar is going down. It should be telling us that the money multiplier should be rising. It should say, hey, it should be screaming, there's inflation, or it's coming. And the money multiplier says, nothing. Why is that? Because what is the bottom in the denominator of the money multiplier, the monetary base. Who drives the monetary base? Sorcerer JP and his spell of QE. Do you see there's a problem here? The Fed is counteracting the effects of the dollar. It's right before your eyes. All right, let's look some more, because look at the consumer price index. Now, I know I just lost more of you again. Just the way it goes when we talk CPI. But look, the CPI is rolling over in red, and the money multiplier dipped down and is flat. It's telling us there's probably no more inflation coming in the November data, which we'll get here in a couple weeks, maybe next week or the week after, not sure which. It's telling us that the dollar is having no effect, none. And that is crazy, that all this dollar selling has been counteracted by the Fed. Because as I said, it's effectively a zero duration bond is all it is. And look at the money multiplier against 10-year Treasury yields. Not even 10-year Treasury yields responded to the move higher in the money multiplier. It's telling us, that the bond market's telling us, look, there really isn't going to be any inflation here. And that also tells us the money multiplier is more likely to head lower because the Fed will be pressured into doing more QE. Let's look at gold, right? Gold should be, skyrocketing. We're hearing from people that are massive gold bulls. I mean, they're beside themselves, right? Everyone's like, it doesn't make any sense. I know how that feels. Gold has to be going up here, right? Look at the dollar. Well, let's look, because it's telling us something is wrong in the system. Because when the dollar goes up, gold tends to go down. And when the dollar goes down, boom, gold goes way up. And look, the dollar's going down and gold's going down. That doesn't make any sense. It's telling us something is wrong. What about crude oil? People are really bullish about crude, saying it's going to go to $70, maybe $80 a barrel. Why is that? Because the dollar's going down and crude oil's not going up that much. If you look at where the dollar is right now, it usually suggests that crude oil should be higher than it is now. There are many times here it's in the 60s, 70s, and 80s. It's telling us, again, something is wrong in the system, or the quantitative easing is being extremely effective in what it does. So here's again the trade-weighted dollar against 10-year Treasury yields, and I inverted the trade-weighted dollar on this chart, because what we can see is the dollar is shooting up higher, or lower. I got upside down, and now I'm upside down, and yields aren't responding. So what does it mean for the dollar? That it's going the wrong direction, and the probabilities are it's going to reverse. Because when yields are rising, when yields are rising and the dollar is, now I'm all goofed up, but nevertheless, when the dollar's rising and now I'm backward because I got it upside down. So we'll just move on to that poor relationship that I was trying to make. I'm sure you figured out that the bottom line here is the dollar is trying to tell us that interest rates should be going higher, and they're not, which tells us what direction the dollar is likely to head. Up. And if the dollar is not having an effect on crude oil, export prices, gold, inflation, what's going to happen when it starts to rise? It's going to be a massive wrecking ball. Because what we're really learning here, right, is financial conditions are tight. And that there's so much deflation in the economy that not even a massively, aggressively weakening dollar is slowing it down. It's barely slowing it down. That's how big the deflationary pressure is in the economy. And yet everyone is massively bulled up on stocks, massively bulled up on risk assets, short the bond market, short the dollar, and they can't see the deflationary pressures. It's there. It's all over the place. And so that, my friends, is why we're seeing what we're seeing in the dollar. That you now understand why people are so bullish on risk assets, and yet at the same time, the money multiplier and Treasury yields are telling us, look, the dollar isn't going, it can go down, but it's not doing anything. And when it goes up, it's going to be very, very bad for the economy and very, very, very bad for risk assets. So that's how I could still be bullish on the dollar. I know some of you are going to jump into the comments and say, you are crazy. I'm being nice. All right, let's get into the economic data. We'll move into Wednesday here. We've got the Thursday data. Sorry. Challenger job cuts. What are these? These are when large employers announce future job cuts. So in November, 64,800 jobs were announced that will be cut in the future. How about the unemployment claims? Well, the initial claims beat expectations of 712,000, which is a ridiculously high number to begin with. But what about all forms of pandemic insurance? They fell 350,000 to 20.163 million Americans still on some form of unemployment insurance. And remember, the PUA and PEUC, which total over 13 million people, is set to end in December 26th unless Congress passes something. We'll see. We have to hope that they do. How about the services PMI? November says from market said up 58.4, a little higher than last month, saying the services sector is expanding. However, it's expanding from still a very weak point. The more official, although not government sanctioned, ISM non-manufacturing PMI slowed slightly to 55.9, giving us an indication that the PMIs are slowing down if we follow the ISM, accelerating based on the market. The key thing here to me is not that just new orders are high, and that will likely probably slow down, is the employment. Employment at 51.5 is saying there's virtually no change in employment. So the services sector is not adding people back. That is probably the biggest issue. Is employers are doing more with fewer people, and they're sensing that perhaps this order demand is going to go away and they have enough employees to meet it, and then who knows? It's bad. All right, let's move on to the payroll report. Missed expectations, and yet stocks went up and bonds went down. That I know baffled you as much as it did me. Non-farm payrolls at 245,000 jobs, which is pretty much what you get in a normal month outside of a pandemic and outside of a recession. So this is not an impressive number. We did see hourly earnings up 0.3% and on a year-over-year basis up 4.4%. So those who have jobs and are working are definitely making more money. Maybe they're picking up overtime. I'm not sure. We saw imports and exports both increase a couple percent, which is always good news. The participation rate fell. Now, this is a problem. If we go here and look at the labor force participation rate, you see it rolling over in red. And what is that telling us about Treasury yields? That there's a limit to how far these things can go. Everyone thinks that yields can just go up, 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 and up. But based on their relationship with labor force participation rate, it's saying not going to happen. Doesn't mean they can't go up a little bit more, but generally that trend is near to the end. And the unemployment rate, wherever the official, here it is, dropped to 6.7%. Part of that because fewer people in the workforce. That isn't pretty. Now, we look at the bond market, courtesy of Brent Johnson, giving us the speculative positioning on the long bond. And what did we find out? And many of you pointed this out on Twitter. You were absolutely right that this means that speculators increase their positions by 33,000 short. And you see that it's hard to see because the line is moving right back down. So we're right near the all-time record short position. And based on what we saw in the price action today, it is likely that they're back at that all-time short, just looking for interest rates to go higher. And they're pushing on a string, can't get the bond market to move at all. And one of the challenges, as I mentioned on Twitter today, is the bond market isn't just a function of speculative selling. It has to be met with lending growth. I mean, you can drive interest rates up, but they will ultimately be rejected if it doesn't follow lending growth. Well, what did we get in the lending picture? We have to go to the H.8. Bank credit expanded by $22 billion. Which is good, except when you find out that banks are filling that bucket, the holes in the bucket, the water's running out, and securities and bank credit rose $22 billion, with mortgage-backed securities up 16, U.S. Treasuries up 3. And you're like, well, why aren't they buying more Treasuries? Well, maybe they can't keep up. Maybe the demand of the Fed's QE is just keeping them from adding a whole lot of these things. And this was at the week ending November 25th, which was November 27th. So before this sell-off this week, at the end of this week, yes, the banks bought $22 billion in bonds. Loans and leases, all commercial banks down $4 billion. Commercial industrial loans down 10. Residential real estate up 12. That was probably the Oh, wait, I'm sorry. Did I do that? Yeah, I did the math wrong. That would be down 12. Oh boy, hate it when I punch stuff in the calculator wrong direction. So residential real estate down 12 billion, commercial real estate up 1 billion, consumer loans up 4 billion, mostly probably on the credit card data. A little bit, and it's kind of spread a little bit along the rest of them. Let's flip over to the PowerPoint real quick, as we are running thin on time for the show today. Money supply is up but slowing down a bit. Growth rate is at 25% over last year. The long-term trend is just a 6.2%, so it's not a really big deal. But the 6 and 3 month rate of change are still moving up pretty high. How about real estate loan growth? Down to 1.38% from last year. 6 month rate of change is negative. 3 month rate of change is flat. This is danger zone. I mean, we're well past the danger zone of residential real estate growth. We've seen market crashes at this level in the past. That's a great financial crisis. So not a good trend, record low rates, and yet credit is contracting. Commercial industrial loans down to 11.46% from a year ago. The 6 month rate change is at almost minus 12. 3 month rate change is at minus 6. Not a pretty picture there. That thing is on a destiny to be a negative on a year-over-year basis. Loans and leases, all commercial banks down to 3.68% from a year ago. 6 month rate change at minus 4. 3 month rate change is at a little over minus 1.5. Up slightly on the 3 month rate of change, but not much. Consumer loans, here you go, up to minus 10.2%. Thanks Black Friday, we got a little bit of activity on credit cards, but not a whole lot. And with that, we'll leave off on the one chart on bonds real quick. Someone said the speculators look like they were right. I will tell you this. Speculators started their short position. Let me show you real quick. Back in roughly October. Where is it? You can see where the zero line is at right in here. They started shorting late. They were short in 2018. So where do we have on the chart of TLT 2018? Pick your poison in here, wherever you want to start. Bond prices are up. Speculators are net short. If you look at this from a technical perspective, you have held the bottom that went back to about this time in November, which held back in this time back in June. So the current level, just over 1.7%, seems to be a fairly strong line in the sand for the castle walls. And with that, my friends, I appreciate you watching, appreciate you being here. We'll be back on Monday for the macro show. And for those that love it when, be sure to like, subscribe. And for those who love it when I read the thing, yes, it is in the description. For those of you who think that I'm doing something weird, I just have fun reading it because the big boss, he likes it. So have a great weekend. Bye now. The content of this video is provided as education and informational. It is not intended to provide investment or other advice. It should not be construed as recognition or solicitation by security, financial instrument, or participate in particular trading strategies. Videos, pair advice to manner, all pros, capacity, business, press, and will not affect the financial. Inc. or Steven Van Meter Financial. Woohoo!